I think we can all agree that, at least in crypto, fundamentals don't always matter, right? Why else does Dogecoin have $1 billion of market cap? Why else are most assets on the Solana chain meme coins? Why is everybody trading meme coins in the billions and billions of dollars if fundamentals were to matter whatsoever? So when it's not fundamentals that matter, what does actually matter? What actually makes the prices in crypto? What makes prices go up and down? I believe psychology plays a huge role. And within psychology, there is one concept that I like the most. And that concept is the reference price. It's the price that you got in for a token and the current price relative to that purchase price. So how much are you currently in profit? How much are you currently in losses? And when we zoom out a little bit, we can expand this further, right? How much is the market in aggregate in profit? How much is the market in aggregate in losses? Because think about it this way. If you bought a meme coin and that meme coin suddenly shoots up way faster than you expected, you're a lot in profit, then you might consider to sell, right? You've got a lot of the token price went up, you might consider selling. However, when the meme coin goes down, you might consider holding rather, because at some point you were convinced that this meme coin will rise. Thus, maybe you're hoping for recovery. There is an increased likelihood of you selling when a price shoots up. Then there's a decreased likelihood of you selling when the price is rather tanking or going sideways, when it's doing nothing. Thus, again, when we expand this out for the entire market, if the entire market is currently in profit, there is some increased likelihood of a correction. And that explains to a degree that when an asset tends to just slowly creep up, right? When it increases maybe by 100% over 3 or 4 months, we don't really see violent corrections, right? We don't really see how the price suddenly drops by 40% tomorrow. In most cases, right? If not, the overall market is crashing because of COVID or something like this, right? In most cases, we see when there's little volatility to the upside, that there's also not that much volatility to the downside. So it works in both directions. However, if a meme coin suddenly shoots up by 3-4x within the span of a week, they can also correct by 50% tomorrow very easily, right? This happens very easily. In other words, because people that bought in before that massive rally are that much in profit, there is an increased likelihood of that profit to be partially taken. People take profit of quick gains. People aren't taking profit that quickly when the gains develop rather slowly. Now, what does it mean that the market in aggregate is in profit? When we are at an all-time high for any asset, that means that everybody is currently in profit, right? When you look, for example, at Bitcoin, and you look at what point in time did the Bitcoin price move the last time, you look at all the different Bitcoins, and you check, okay, Bitcoin 1 had moved at $1,000, Bitcoin 2 had moved at $2,000, etc., but Bitcoin 3 moved at $3,000. Right? It goes all the way up to today's prices, but we see how the Bitcoin moved at different prices, and the current price is simply just the price at which Bitcoin had been traded the last time, just recently. The people that bought beforehand, they are in profit relative to that last transacted Bitcoin. The technical term for the average price of all the Bitcoin that had ever moved on-chain, the technical term for that average price is the realized price. So check out this chart of the Bitcoin realized price. It's currently at around $30,000, which means that with the current prices, Bitcoin holders in aggregate tend to be more than 2x in profit. They tend to be more than 100% in profit. It doesn't mean that we have to crash from here to 30K, but it means that that is the potential downside. If the current momentum breaks, if you're not going further up from here, if you're simply going sideways for several months from here, then maybe some people might consider taking profit. And that profit taking, if the momentum turns around, could be all the way down to 30K, maybe even below that, right? We have seen in the past several times how Bitcoin was below the realized price. And so buying whenever the price is below the realized price is very good usually, right? If you long-term believe in the asset, if you believe that the asset will stay around for the next decade, then buying low makes a lot of sense, and especially buying when most people are in losses and they are less likely to sell. that's a good bottom opportunity. That's a good opportunity to pick up the pieces when nobody else wants to buy, when everybody is very bearish. So this works over the very long-term macro in Bitcoin, but this also works for the short-term trading in meme coins. If a meme coin goes up massively, say by 100% in just a matter of a few days, when you then look at the buys and sells, have a look at this chart over here. This is taken from dexscreener.com. When you look at this portion at the top right, you see the number of buyers and sellers, and you can also see the buying volume and sell volume. Now what we see in this particular case is that the price of the meme coin went up quite a lot. We still see that the number of buyers exceeds the number of sellers, but we see that the selling volume relative to the buying volume is larger. So the sellers tend to move more tokens than the buyers. Why is that? Because the sellers, they take profit.
This video is sponsored by the Premium membership. I never take any money from any crypto project. I never take any affiliate links from centralized exchanges. I never pump and dump coins. Instead, I offer valuable tutorials in the Premium membership. Feel free to check it out.
When you bought into a meme coin for $1,000, and now you've got $2,000 worth of the meme coin, when you then sell, you're putting $2,000 of sell pressure on the asset. So if there's still buyers with the same $1,000 of volume, then suddenly it takes double the amount of buyers versus the sellers that bought early in order to just keep the price stable. So simply because a lot of people are in profit, they've got more power over the price. And for the price to continue to rise after it doubling, we need the number of new buyers to be double the number of sellers. And that's why we see those massive corrections. That's why when we've got a 4x in a price, we can easily see a 50% drop just in a few hours after that rise. So the elevated prices are available only for a short period of time. People are taking profit. And the faster the growth in the price is, the more aggressively people are taking profit and the more power the sellers have over the buyers. So the reference price is a really, really strong anchor. You are way more inclined to sell if you made quick gains than you are when the price is just going sideways. You are way less inclined to sell Bitcoin when you've held it for a year and you're slightly in losses versus when you held Bitcoin and you're already double in profit. So looking at the realized price long-term for Bitcoin makes a lot of sense, especially for risk management. Always plan for the worst case. Always plan that Bitcoin could go down to 30K. If that is very bad news to you and you couldn't stomach such volatility, then you are over allocated to Bitcoin, I believe. The same is true for meme coins, right? If suddenly the price shoots up by that much and everybody is that massively in profit, consider taking at least your initial out. The more the price went up, the more you should consider this, right? If you made a 3x within a week, at least take the initial out. If you make 100% within a single day, maybe take a third of it out. I believe it makes a lot of sense to be more aggressive with profit taking the faster we are going up. Because this is what people mean when they say the market is overheated. It simply means that the people that bought low, they are now that quickly, that massively in profit, that they take advantage of those high prices and they depress the price a lot because they've got so many tokens that they bought low. They can depress the price a lot because they've got more power over the market than all the new entrants. If we simplify this all, right? If we say all the new entrants in a new token put in $1,000 and the price goes 4x within a week, suddenly, in order just for the price to be stable, you need 4 times the number of buyers versus sellers. And if you want the price to go even higher, you need 5 times, 6 times the number of buyers versus sellers. So it's all about momentum. It's all about psychology. It's not necessarily about fundamentals. And this is across the board, at least within crypto, where people are not necessarily trading the yield, where people are mainly trading the attention. If it's your first time here, feel free to subscribe. Feel free to also like. This helps the channel grow. And of course, feel free to also join our Telegram. There is a Telegram link down below. Feel free to check it out. Looking very much forward to chatting with you over there. The channel is completely free, so hope to see you there. Cheers!